Um, I'm Carly Ebenstein. I'm a long-term care specialist and independent broker here in Denver. And today I'm talking again with Kevin Guttman, who is one of 218 certified specialists in reverse mortgages in the United States. He also has a best-selling book on Amazon, which we will link to in the description below, because this topic is vast. I feel like, I had no idea how complicated and how interesting and how nuanced the topic of reverse mortgages is. And that's why Kevin's here for the third installment of this conversation. And today we're going to be talking about beneficiaries. So, Kevin, is there anything you'd like to add before we get into it?
No, it's great to be back, Carly. Thank you.
Sure. Sure, great. Okay, so just for people who might be clicking on this video first, can you just give a very brief overview of just reverse mortgage and how that works?
Absolutely. So in 1961, a widow took out a reverse mortgage because she could no longer afford to stay in her home. She knew a local banker because her husband was a football coach. The banker played football for her husband in high school. And he went to his bank and said, listen, this lady has a lot of equity, but she lost her husband, cannot afford the monthly payment anymore. Can we suspend her payments and allow her to remain in her home and take payments from equity? And so the very first reverse mortgage was born, 1961. For 27 years, it was not regulated. So it was kind of the Wild West. We had a lot of versions of a reverse mortgage out there. And unfortunately, people got taken advantage of. Some people lost their homes. Some people had to sign their home over to the bank. That has not been the case since 1988, when President Reagan and Congress passed the Home Equity Conversion Mortgage Bill. They made it a 10-year trial bill to see if it would help a senior homeowner remain in their home, age in place, retain ownership on title, gain access to their equity, not have a monthly mortgage payment, and really entertain the lifestyle they've worked for and dreamed of during their working years. And they made the law permanent in 1998. And over the years, they've worked hard to make the program safer. So just a quick side note on that. I first got trained in reverse mortgages in 2007. And there were some things about them I just wasn't really sold on. I just didn't know, well, I'm not sure about that. So I put it on the back burner, didn't do anything with it. 2015, HUD and Congress changed those things that I had concerns about. So
Hmm.
now, since 2015, I've been originating reverse mortgages. It's more than half my business, probably two-thirds of my business now. And it really is a game changer, just helping so many people not stress about outliving their money is kind of the bottom line.
Gotcha. And that's important. That's very relevant as people get older and they're living on a fixed income, especially with market, um, vicissitudes. Some people get very nervous. But let's take a step back, and I want to just try and cover a different angle. And I'm wondering if you can talk about maybe from the beneficiary's perspective and why a beneficiary or benefit group of beneficiaries might be, I don't know if excited is the right word, supportive, encouraging of somebody like maybe their parents taking out a reverse mortgage.
Yeah, that's a great question. So whenever we sit down with somebody, whether it's in person or by phone or by Zoom, I always just ask them, I said, okay, well, how long do you plan to stay in your home? What's your long range goal? And what are your options? Have you thought about selling? Maybe renting? Um, can you go live with your kids? Can your kids help you? Et cetera, et cetera, et cetera. And what it comes down to usually is the children have their own homes and families, and they're in the middle of raising kids, and you know how expensive that can be. And so they're not in the position normally to help out mom or dad. So in most cases, I think the statistic is 91% of people don't want to move. They want to stay in their home as long as they can. So you've got the perfect storm. You've got somebody who doesn't want to move, concerned about outliving their money, has limited options, and so now they're willing to look at tapping into their equity. And the way the
Hmm.
loans are structured now, Carly, they can only borrow about 35 to 45%, maybe even 50% if they're up in their 80s or 90s. Might be a little bit more, even low 50s if they're in their 90s. But bottom line is there's going to be equity at the end because they're not borrowing that much. So they only pay interest on the amount that's borrowed, and there's almost always equity at the end with how these loans are structured these days. So one of the things we hear from clients is, I want to be sure I leave something to my kids. And
Hmm.
so the way reverse mortgages work now, that almost always happens.
And I'm wondering if you can tell us about any maybe I don't know if creative is the right word, but um, possible interesting ways to structure a reverse mortgage to preserve a portion of the home equity for heirs.
Great question. We actually just had a lender this week come out with a way that we can determine how much the borrower wants to preserve an equity to give to their children. They just launched it this week. So if we would have talked a couple weeks ago, we didn't even have it. They just launched it. And they're the
Wow.
only lender out there that has this right now. But what tends to happen is one brings it out and the others kind of follow eventually. So they can say, for example, I want to leave X percent or X dollars to my heirs. And then once the loan balance reaches that limit, let's just use simple math. Let's say it's $100,000 value, and they can borrow 40,000, and they say I want to give 20 to my kid. Just simple math. I know these numbers are not accurate.
It's
Okay,
okay.
so once they've already borrowed 20,000, they have no more available to them because they've elected the equity preserve option.
Hmm. Okay. So with a little planning, that can easily be achieved. Now, maybe not a month ago.
Yeah, and it just shows you, it's interesting. It just shows you how fluid the market is right now because everybody's scrambling for market share because interest rates are still high, 40-year high, and lenders are slow. So they're looking for creative ways to generate more business. And this is one of the things we hear a lot from people is, I don't want to use up all my equity. And now, at least we can preserve part of it for the heirs. So that's a great thing.
Yeah. Yeah. And so I'm just kind of thinking like down the road, after nobody is living in the home, which means that the reverse mortgage loan money is due. Are there any safeguards that can be put in place to ensure that heirs aren't left with unexpected debt or financial obligations besides having to rely on there being equity in the house? Like hypothetically, let's say there's some incredible downturn at the time the house needs to be sold,
Yeah.
or I should say the debt is
So
due.
yeah. So that's one of the beautiful features of a reverse mortgage. It's a non-recourse loan. Unlike traditional mortgages where we're personally liable to pay it back, with a reverse mortgage, it's a non-recourse loan. What that means is the only recourse the lender has to get their money back is the sale or refinance of the home. And with the FHA reverse mortgage, it comes with mortgage insurance. Now, normally, mortgage insurance protects the lender. In this case, that's true, but it also protects the borrower, their estate, and their heirs. In other words, to directly answer your question, no debt can ever be passed on to the estate, to the heirs, to the borrower with a reverse mortgage.
So if the loan balance exceeds the home value, then it's the risk that the bank has taken and the heirs aren't on the hook.
Correct. And think about it as a taxpayer. None of us wants to be bailing out Joe down the street because his reverse mortgage is underwater. There's where the mortgage insurance kicks in. If by chance, and remember they're borrowing such a low amount, it's unlikely that they'll get underwater. But let's just say they draw on they max out the available loan amount to them at the beginning. Interest rates stay high. Property values plunge. They live longer in the home than the government thinks they will. FHA thinks they will. Now they're underwater. right? All those things would have to happen for a long period of time for them to be underwater, but they're underwater. So then what happens is now they owe, in our example, they owe 125 and the property is only worth 100. The mortgage insurance kicks in and makes up the difference. Unless, this is, you asked about what's an illustration where it's unique, unless one of the heirs, one of the direct heirs, a son or daughter, wants to purchase the home. If they want to purchase the home, they can buy it at 95% of the appraised value. In their example, 95,000. Even though 125 is owed, the direct heirs can buy it for 95% of the appraised value. So, I mean, they've really structured it well, and I'm not always the hugest fan of government programs, but this is very well thought out and really benefits seniors and protects seniors and their heirs.
I mean, you've been doing this long enough. I'm sure you've seen like a whole variety of situations that played out. Have you, are you aware, either directly or indirectly, of a situation like that, which seems extreme, like the perfect storm, but it can happen.
You know, we've had great um, property value increases from mid 2015 until just a few years ago when it's been pretty flat. But because of that, good property growth, especially in Colorado, we really haven't seen anybody get underwater. And by the way, back in 2015, you could borrow 60%, not 35%.
Okay.
So over the years, the government has cut back how much somebody can borrow to where now, and it's based on three things: the value of your home, the interest rate, and the age of the youngest borrower. Those three things determine how much somebody can borrow. So it's just like a traditional loan. If you have higher interest rates, your borrowing capacity is lower. Same thing with a reverse mortgage. We used to, 3 years ago, 2022, we were telling people and offering people 50% loan to value. But now, as I said, it's down more like 35 to 40, 45%. So the bottom line is it would truly have to be a perfect storm for somebody to be underwater.
I have another question, but your answer here just has prompted a different question. You mentioned about the three components about determining how much someone can borrow. And so I'm just wondering how age impacts that, because I can see it going both ways, where a younger person can borrow more or an older person can borrow more.
So the older you are, the more you can borrow. People always ask, what's the perfect time to take out a reverse mortgage? I say the day you qualify, because I'll give you an example. 2021, we were talking to people, and they said, no, we want to wait. We're not ready. And then the next year, the year after, they called, and either they lost their job, lost their income. By the way, most people qualified just with Social Security, but or their debt was too high, or they got some late payments and had to have a forced escrow account, or the interest rates went up and now they couldn't borrow as much, so they didn't qualify. We had several people in that boat. So the best time to get one is the day you qualify. And then the other thing people ask is, well, can I make a payment? Payments are not mandatory as they are with a traditional loan. They're optional. You can make a payment if you choose to. I had a lady the other day, she goes, I don't really want to eat up my equity. So we sat there and we figured out how much interest it was going to be charged each month. And then she said, okay, I'm committing to make that payment each month because I do want to give my equity to my kids. So I think one of the things people love about a reverse mortgage is just the flexibility that it gives them. The money's there if you need it. You don't have to use it if you don't want it. In the meantime, it can grow by compound interest on the line of credit month over month, and then eventually you can turn it into monthly payments. I mean, people just love having that money available. They may never need it, but it's there if they do.
Hmm.
And
I
there's no
can,
payment required.
right, right. And again, with all of the years that you've been doing this and helping a whole variety of different clients, have you had clients that maybe got a little bit more creative and combined a reverse mortgage with hypothetically purchasing life insurance to help, to pay to cover that amount, just so that they have that cushion for themselves, but then they're also doing a little future planning for their heirs.
Yeah. In fact, I write a lot about this in my book. just different stories of people have used them. It's kind of like a fingerprint. It's very unique to each individual. The only restriction, Carly, that somebody has if they take out a reverse mortgage is they can't purchase an annuity. They can do anything else they want. So I've had people self-finance long-term care with equity in their home. In other words, they get a line of credit, let it grow. Eventually, they can turn it into payments to pay for care in the home. I've had people take money out to pay for the long-term care premium each month or each year. So really, the equity is paying for the long-term care insurance policy. I've had people who've said, I don't want to, I'm going to be forfeiting, X thousand of equity, so I'm going to take out a life insurance policy to make up that difference, because when I pass, my heirs will be the beneficiaries, and they will receive that money tax-free. So it's pretty much the same as if they inherited the house or the equity in the house. So yeah, we've seen lots of ways people have used the equity now to live, but then leveraged it with long-term care or life insurance, for two specific examples, so that more is given to the heirs, and also they've lessened the exposure they have with their medical expenses.
I'm kind of curious about how much some of those more creative options, if people, treat you like a thought partner, or, kind of are looking for counsel, in terms of different things, and how involved you get, or if they come because maybe a financial advisor has sent them to you and they come with, set ideas.
Yeah, there's two categories of people when it comes to a reverse mortgage. There's the need them and the not need them. Historically, most reverse mortgages have been need them. They're out of money, they're broke, this is like a last resort, last ditch thing, they got to get a reverse mortgage. I'm seeing more and more people of the not need them because of what you just said. They're being referred by CPAs or financial planners or their attorney, and they see the strategic part of tapping into equity to leverage other places in their life, i.e., giving away their estate while they're still alive, right? Part of their estate while they're still alive.
Gifting.
To kids or grandkids or charity. Like we just talked about, life insurance or long-term care insurance. Some people have bought rental property for another income stream from that. Like they make a down payment from their equity, have an income stream from rental property, or even a business. Or sometimes people use it just because they're like, look, I've got a window right now where I want to travel. Maybe you've heard of the go-go years, the slow-go years, and the no-go years. So they're young, they're in their 60s. They like, man, we want to go. We want to see the world. We've worked our whole lives, and this is our shot to go and take a cruise or take that once-in-a-lifetime trip, and the equity from the house can pay for it. So it's really limitless or unlimited what somebody can do. And we try to mine that for them because we want to understand the motive behind it so that it really benefits them. We're not looking just to close a loan. We really want to improve somebody's lifestyle.
Sure, I can tell that. Well, Kevin, this has been great. I've learned so much in these 3 series of conversations, and I'm sure anyone who's watching these videos has as well. And hopefully, they'll purchase your book, and even better, reach out to you to see, it's kind of explore to see if a reverse mortgage makes sense for them.
That'd be awesome. Can I just share one more thing that your listeners might be interested in?
Sure.
And it might help your practice too. So I had a lady the other day ask me if she should put her son on the title. And I said, well, what's better is if you create a beneficiary deed. So a title company or an attorney can do this for a client. And basically, it sits until the person passes. The person passes, the beneficiary deed's recorded, ownership transfers from the deceased to the heir. And it's very seamless, very smooth, very affordable. They don't need a trust. They don't need a will. Those things are great, but they don't have to have it if they have a beneficiary deed in place. So, these are important things, and we encourage people, go meet with an attorney and get this set up so that can be a smooth, seamless transition at the end when you've ultimately don't live in the house anymore and went on to eternity. So. Hopefully
So
that's a
with
little tidbit that helps.
yeah, definitely. So with this option of the beneficiary deed, as you say,
Yeah.
is there when that goes into play and the beneficiary actually inherits the property, is there a step up in basis?
I've been advised not to answer questions outside of my license. So I'm
Smart,
sorry, I can't really
smart,
answer.
smart. But I think for
Probably,
anyone
but I
watching
can't
this,
say.
but anyone watching this, that would be something, a question you would want answered beforehand, just so there are no surprises. But we're always looking at options, and that's a good option to know about.
Absolutely.
Yeah, you're like me, Kevin. I know enough to be dangerous. I think you know enough to be dangerous.
And I don't want to give out wrong information, so that's a good question for a CPA.
Sure, sure. Well, this has been great. I've really enjoyed this series of conversations, and something tells me that we might have even more to discuss.
Well, it's been a real joy, Carly. Thank you for having me.
My pleasure. Take care, Kevin.